Hello there. I'm your host, Arthur Richier, Head of Strategic Partnerships at Vortexa, working alongside our global partners from our Dubai office and amplifying market intelligence for Vortexa Analytics. I'm really happy today to be joined by Xavier Tang, Market Analyst at the Vortexa Singapore office. Today, we're going to focus on the Iran-Israel conflict and what we've seen happen in the Strait of Hormuz within the 12 days of the escalation, and why the markets were highly concerned to begin with. Now, to give a bit of a background on what happened, over the past couple of weeks, we've seen rising tensions between Israel and Iran. It's raised serious concerns about potential conflict spilling into the Strait of Hormuz, which is a critical artery for global energy flows. Now, we know roughly a fifth of the world's supply moves through the narrow passage, so any disruption there has global implications and causes high volatility. Now, following a ceasefire announcement on Monday, US time, the immediate threat to global shipping has eased. We've seen Brent oil price reach almost the pre-conflict levels shortly after, but it is a reminder of how geopolitics and energy markets remain tightly linked. In this episode, we're going to revisit the key factors that amplified the volatility around potential, albeit unlikely, Strait of Hormuz closure. With that, let's start. Now, as I mentioned, a significant percentage of crude oil from major Middle Eastern producers, Saudi Arabia, Iraq, the United Arab Emirates, and Iran, rely on the Strait of Hormuz to supply Asian markets. Now, Xavier, going on to you now, price change was relatively muted. It rose to about $10 a barrel on top of the price before the tensions, and then returning back to levels seen about 2 weeks ago over a very short period of time. Why is that?
Yep, thank you, Arthur, for the question. Now, let's take a step back and think about what has actually happened in the past. Now, historically, whenever there are disruptions or outages in the oil markets, the market find ways to navigate around the situation, be it the traders taking advantage of price dislocation in different regions, or refiners adjusting their refinery runs according to the refinery margins. Or sometimes we see governments releasing some of their strategic petroleum reserves to balance the oil markets. Now, there are a significant amount of crude supplies coming from the Middle East Gulf through the Strait of Hormuz. And we can see that on average, volumes are around 13.5 million barrels over the past 12 months. And in the first 3 weeks of June, we have seen an increased amount of exports coming from this region. Some of the increases are due to front-loading activities amongst the Middle Eastern countries, and Iran as well, in particular, has increased its loadings 2 weeks before the Israeli strikes. However, we could see June export volumes normalize closer to the end of the month. Now, the market is also increasingly aware of the massive amount of oil in storage and the wider supply chain. 3.3 billion barrels of crude oil that's being stored in the onshore storage tanks, and typically around 1.1 to 1.2 billion barrels at sea. And that makes about 4.4 to around 4.5 billion barrels of trapped oil. Now, assuming an average of about 13.5 million barrels per day of crude that was being exported out of the Middle East Gulf through the Strait of Hormuz is entirely lost, global crude in the supply chain could cover for such a situation for around 13 months or so. Now, there is also 4.6 million barrels a day of product exports going through the Strait of Hormuz, and that could probably be covered for more than 2 years or so. Now, however, do note that this is sort of like a worst case scenario whereby the Strait of Hormuz is entirely shut, and the probability of this happening is extremely low.
Thank you, Xavier. I'm sure that 13 months is a number that will reassure most people in the market and really does help explain why the price change was relatively muted. Now, in the worst case scenario that you mentioned of a complete closure of the Straits of Hormuz, however unlikely, how are major crude importers affected?
Now, before we dive into the figures, I just want to highlight the relationship between the Middle East, Gulf, and Asia. So about 90% of crude supplies that are being exported out of the Strait of Hormuz goes to Asia. And when we look at the full import basket of Asia, crude supplies that are coming from the Strait of Hormuz represent slightly over 50% of Asia's total seaborne crude imports. Now, looking closer at the top four crude importers from the Middle East Gulf region, we can see that these countries are heavily reliant on the Strait of Hormuz for crude supplies. And thus, any shortfall in terms of crude intake from the Middle East Gulf regions needs to be covered from other regions. Now, when we look at the percentage share of imports from the Middle East Gulf via the Strait of Hormuz for the top four importers, we see that Asia's biggest importers, India and China in particular, rely about 41% and 48% of their seaborne crude intake from the Strait of Hormuz. As these countries have access to alternative barrels such as the Russian euros as well as Russian ESPO supplies. And these crude are mainly the medium sour barrels. Now, in contrast, South Korea and Japan only have access to the mainstream barrels, and hence they are more reliant on these Middle Eastern barrels, taking up about 73% as well as 63% of their total seaborne imports, respectively. Now, I think what's really important to know is how long these countries can go without crude supplies coming from the Strait of Hormuz. And over on the right-hand side chart, we are showing the import cover of onshore inventories of these top four crude and condensate importers from the Middle East Gulf via the Straits of Hormuz. And that's it. The inventory import cover days are calculated based on the tracked onshore crude stocks, and that excludes the underground SPR. And we divide it by the 12-month average crude and condensate imports from the Middle East Gulf via the Straits of Hormuz. And what we can see is that China as well as Japan have a relatively healthier import cover of about 7 and 6 months respectively, whereas India and South Korea have a relatively shorter import cover of about 2 and 1 months respectively. And this means that if there were to be any disruptions in supplies at the Strait of Hormuz, India and South Korea will need to take more proactive measures to find alternative barrels elsewhere. We have also added South Korea's import cover estimates from Jody and IEA. And do take note that the IEA figures are based on both the crude as well as products. And hence, these figures appear larger in comparison to Vortexa and Jody.
Thank you for your insight, Xavier, on crude markets. Now, we know of the link between crude markets and freight markets, and obviously the volatility in the former has impacted the latter. So moving on to freight markets now. Now, one of the questions we've gotten from a lot of our partners and clients has been what's going on to the actual vessels themselves in terms of transits through the Straits of Hormuz. So as of now, have we seen any changes in freight transits through the Strait of Hormuz?
Yep. So before we dive into the figures, I would like to also mention that although the likelihood of Iran closing the Strait of Hormuz may be quite minimal, the market is closely watching these key transit locations. Now, as the time of recording on 26th of June, we have seen both dirty as well as clean freight rates pulled back, and that's due to lower war risk in the Middle East, given that Trump has actually announced the ceasefire between Israel and Iran, and that both countries seem to be honoring the agreement right now. That said, we have also tracked the weekly tanker transits for MRs and above through the Strait of Hormuz, which have remained pretty much normal when we compare to data from the past 5 years. And they have also been pretty much in line with the 2024 average levels. do note that these weekly transits exclude the dark vessels without the AS signals and also the sanctioned tankers. So far, we have not seen operators avoiding transiting through the Strait of Hormuz, but we have observed instances whereby vessels have waited outside the Strait of Hormuz and only appear to transit through the Strait of Hormuz when necessary to make a laycan window. Now, when we look at the average tanker transits on a seasonal basis, we can see that the daily average transits for the first 22 days of June have reached seasonal highs. And that's the function of some of the front-loading crude exports we have seen from Middle Eastern countries. Now, the transits for the week ending on 22nd of June were robust. That's 4% above 2024 average levels, and also slightly higher than the weekly average for the month leading to the attack. Now, this strength in overall transits in the third week of June is also worth highlighting, especially because the crude and condensate exports from within the Middle East Gulf were actually very strong in the first half of June, as term contracts as well as front-loading activities saw exports up by almost 20% month-on-month.
Thank you, Xavier. So I'm taking away from this robust transits, but I know our listeners and viewers will want to know more specifically about the VLCC segment. So what can you tell us there for those particular tankers?
Although VLCC rates from the Middle East Gulf have increased drastically since the conflict began and have also reached 16 months highs, rates have started to fall today as of 26 June. And that's due to reduced war risk in the region. Now, although I mentioned earlier in our previous slide that weekly transits were robust for the first 22 days of June, we have observed a slight dip in VLCC tanker transits, which is a function of reduced export momentum in the second half of the month. And this is quite a common occurrence in the Middle East Gulf loadings. Now, we have split the VLCCs entering the Strait of Hormuz and exiting the Strait of Hormuz into ballast and laden vessels. And we have recently observed a decline in ballast vessels entering the Strait of Hormuz. While these recent figures appear to show a below average number of transits, it is important to note that this pattern is in line with the second half of the May, where a similar decline has actually happened. Now, this also aligns with what we have been seeing in the Middle East Gulf crude export markets, whereby volumes are typically front-loaded in the first half of the month, and that's mainly driven by the term contract commitments as well as the operation planning. Now, as a result, the softening in VLCC transits during the second half of June is more of a function of reduced export momentum rather than a structural shift in VLCC transits. Now, as for vessel-specific behavior, we have noticed two VLCCs hesitating to enter the Strait of Hormuz or just circling right outside the Straits of Hormuz. These two VLCCs have likely waited outside the Strait of Hormuz to reduce the spend inside the Strait of Hormuz and only transit when it's necessary to make a laycan window. Now, this interesting behavior also reflects the operators adopting a more cautious approach amid the ongoing geopolitical risks within the Middle East region.
Thank you, Xavier. I'm taking away that all is well that ends well, at least for the time being. I look forward to the next episode of MENA Energy Insights. Thank you, everyone, for listening.
Thank you, Arthur, for hosting me today.